Hello and welcome to my channel Accounting with Sandra. Over the course of the next two videos, we will discuss the accounting requirements for the recognition, revaluation and depreciation of property, plant and equipment as per the requirements of AASB 116. So to get started, let's do a quick refresher of what assets constitute property, plant and equipment and their valuation methods. AASB 116, the accounting standard relating to property, plant and equipment, defines PPE within paragraph 6 as those assets which are held for use in the production or supply of goods and services, for rental to others, or for other administrative purposes, and those assets which are expected to be used during more than one period. As a side note, the definition in paragraph A says assets available to rent to third parties are considered PPE. However, when an entity is renting assets for use in their own business operations, these assets are not considered to be the property, plant and equipment of the entity and are accounted for as right of use assets. I will create a video discussing right of use assets at a later date. Secondly, within paragraph B, it specifically states that these assets are to be used during more than one period. This means that property, plant and equipment will always be shown as a non-current asset on the balance sheet. Upon the initial recognition of property, plant and equipment, the cost of the PPE is to include any amounts paid or the fair value or market value of any other consideration provided to acquire the asset. The types of costs which can be included within the cost of the PPE include the purchase price, including any taxes and duties paid, the costs included to bring the asset to its current location and to have it installed and ready for use, and any other initial estimates of the costs relating to the dismantling or removal of the asset. The accounting standard within paragraph 19 further provides examples of costs that cannot be included in the PPE balance, including any costs relating to the opening of a new facility, the costs of introducing a new product or service, the costs of conducting business in a new location or with a new class of customer, and any administrative or other general overhead costs. Once an asset has been recognized in the accounts, an entity is then provided with the option of two different accounting policies to apply with regards to the valuation of the assets. Assets can be either valued at cost or at its revalued amount. Under the cost method, an asset is valued at its initial cost, less any accumulated depreciation or impairment losses. The net value of the cost less these accumulated depreciation and impairment losses is referred to as either the carrying value or the written down value of the assets. Under the revaluation method, after the initial recognition as an asset, an item of PPE whose fair value can be measured reliably shall be carried at a revalued amount, being its fair value at the date of revaluation, less any subsequent accumulated depreciation and accumulated impairment losses. Revaluation shall be made with sufficient regularity to ensure that the carrying amount does not differ materially from that which would be determined using the fair value at the end of the reporting period. Where an item of PPE is revalued, the accounting standard requires that the entire class of PPE to which that asset belongs is also revalued. A class of PPE is a grouping of assets of a similar nature and use in an entity's operations. So for example, land and buildings, machinery, aircrafts, motor vehicles, furniture and fittings are all examples of different classes of assets. Where an entity applies the revaluation method, paragraphs 39 and 40 of AASB 116 provide us with guidance. As per paragraph 39, where the value of an asset increases as a result of a revaluation, the increase shall be recognized in other comprehensive income on our profit and loss statement and recognized within an equity reserve account aptly named the Asset Revaluation Reserve. Where the same asset is then subsequently revalued and has seen a drop in its value, any amount previously recognized in the Asset Revaluation Reserve must first be reversed out. Where there is any remaining loss to be recognized, this amount is then posted directly into the profit and loss as an impairment loss. So let's explore this concept through a simple example, ignoring depreciation for now. Let's say it is the end of the 2020 financial year and we have had our land revalued. Currently, our land has a carrying value or a book value of $300,000, but according to our latest revaluation, our land is now worth $600,000. So our land has increased in value by $300,000. Therefore, the journal entry we would need to post to bring to account this revaluation is a debit to our land account to increase its value by the $300,000, and then we will establish an asset revaluation reserve where we will credit in the $300,000 increment. Now let's fast forward to 30 June 2024, and that same piece of land has been revalued, but it is now valued at $200,000. So its value has decreased by $400,000. In order to post this devaluation of the land, our journal entry is slightly different, as we have previously recognized an increment in the asset revaluation reserve. So now our journal entry is as follows. We will debit the asset revaluation reserve for $300,000 and therefore clearing out our previous credit entry. As our loss in total is $400,000, there is $100,000 remaining, which we will now debit directly to our profit and loss through the impairment loss account. And we will credit our land by the $400,000 to bring our land account value down to $200,000. So now let's complicate the calculation slightly and assume that we are now dealing with a depreciating asset. Let's say a building. In this case, our building had a cost of $500,000 and has an accumulated depreciation balance of $100,000, which therefore means that the carrying value of our building is $400,000. In this case, before we can post our revaluation adjusting journal, we need to first write off the accumulated depreciation account balance against the building account. This will then bring the balance in the building account down to $400,000. Then, when we post our revaluation entry as we did before, we will once again debit the asset account and credit the revaluation reserve. Once again, if a future revaluation shows a decrease in the balance after we post our first journal to clear out the accumulated depreciation balance, we can then reverse the increment sitting in the asset revaluation reserve before posting any losses through to the profit and loss statement. Conversely, in those circumstances where the value of an asset decreases as a result of a revaluation, the decrease shall be recognized on the profit and loss statement as an impairment loss. Where that same asset is subsequently revalued and has seen an increase in its value, any amount previously recognized as an impairment loss must first be reversed, with any remaining increment to be posted into an asset revaluation reserve. So let's explore this concept through the same simple example. Let's say it's the end of the 2020 financial year and we've had our land revalued. Currently, our land has a carrying value or a book value of $600,000, but according to our latest revaluation, our land is now only worth $300,000. So our land has decreased in value by $300,000. Therefore, the journal entry we need to bring to account is to debit our impairment loss account by $300,000 and we'll credit our land by the same $300,000 decrement. Now let's fast forward to 30 June 2024 and that same piece of land has been revalued and it's now valued at $700,000. So its value has increased by $400,000. In order to post this revaluation of the land, our journal entry is slightly different as we have previously recognized an impairment loss of $300,000. So here we firstly need to reverse this impairment loss of the $300,000 and post any remaining increment into an asset revaluation reserve. Once again, if our example referred to a depreciable asset, the first entry would be the reversal of the accumulated depreciation balance against the cost of the asset before posting the same adjusting journals discussed. So that's it for part A, In Part B, I will discuss the various depreciation methods available and work through some calculations with you. Thanks for your time, and I hope this video has helped you to understand how to value your property, plant and equipment.